Welcome to What the Risk? Exposing Business Blind Spots, an interview-based podcast series that discusses risk management topics. Have you ever been blindsided in a business situation? Think about your entire computer system going down, a supplier that cannot deliver, or your biggest customer declaring bankruptcy, or your new marketing strategy completely missing the mark. These are visceral what the risk moments. Your exact words may be different, but the feeling is the same. When everyone's eyes are focused on the next sale, high-impact, low-visibility risks often get overlooked. We call these blind spots, and these blind spots cause what the risk moments. I am your host, Larry Gordon of Gordon Risk Solutions. Join us on this journey as we learn to ask the right questions, expose potential pitfalls, and empower you to turn the what the risk moments into I've got this victories. Welcome to episode 103, first season, third episode. We've seen rising interest rates this year and its impact on the cost of credit throughout the economy. And in the financial sector, we've seen direct effects of these rising interest rates. Some banks did not have the adequate risk management programs in place to address portfolio imbalances between their assets and liabilities. These were the first banks to fail. During this episode, we will discuss the current banking environment and the differences or similarities to the banking crisis of the 1980s and the Great Recession from our guest, Bill Isaac. He is uniquely qualified to help us unpack the issues associated with the banking environment based on his unparalleled career in the financial services industry, as well as in public service, spanning over 50 years. He was chairman of the FDIC, the Federal Deposit Insurance Corporation, from 1978 through 1985, when over 3,000 banks and thrifts failed. And he was chairman of Fifth Third Bancorp from 2009 to 2014 during the back half of the Great Recession. I expect this to be an in-depth conversation. Bill, welcome to the What the Risk podcast. We're glad you're here.
Good to be here with you, Larry.
So we have a number of interesting topics to get through today. So let me just start by asking you to tell us a little bit about when you got to the FDIC, what you found, and a little bit about what you had to address.
Okay, that's a good place to start. And the first thing I tell you is I was the youngest FDIC chairman ever, even to this day. I was 34 when I joined the FDIC board. And my first day in office, I was actually in Louisville, Kentucky, where I had been with First Kentucky National Corporation. And the executive secretary flew to Louisville and met me at a hotel, swore me in the lobby of the hotel, and we got in a cab and went to the airport and flew to Puerto Rico. That was where we handled the failure of the second largest bank in Puerto Rico. That was my first day in office.
Great day to start the job.
Pardon?
That was a great day to start the job.
Yeah, well, it was a precursor of what was to come, because that's what the next 8 years were like. It was just one failure after another. It was very, very hectic. And we always handled bank failures almost always on a weekend. And so I rarely during the next 8.5 years had a weekend off. I was always on the phone or in the office working on failures and authorizing things and the like. So it was a very hectic period. The FDIC handled some 3,000 bank failures during the 1980s, bank and thrift failures. And so it was a busy time. My first day in the office was Puerto Rico, and to handle that failure. And I didn't have any other, there were 3 directors on the FDIC board, and I was one of the 3, and they weren't there. So I was all alone. I can imagine how I felt at that moment. At that age, being there for a failure of that size. But anyway, I dug in and looked at all the problems we were facing, and decided what we needed to do to get ready for it. And I would tell you that the FDIC was not ready for it at that time. It couldn't be, because it was formed back in the 1930s, and it did handle a number of failures back then. But then we had some, I guess the better part of 50 years since then, and we handled almost no failures. Maybe 5, 10 a year. and they weren't very big ones at that for the most part. So we really were not ready to handle a lot of failures, and not at all ready to handle a lot of big failures. And we had 3,000 employees, and that was not nearly enough to handle what we were facing. We really did expect to have a lot of failures. I probably didn't expect to have as many as we had during the 80s, and I didn't expect as many big ones as we had. But we knew we were facing a lot of problems, and we had to bulk up. So one of the first things I did is start hiring, and we increased from 3,000 employees to about 12,000 during my tenure there, and then we kept on increasing from 12,000 to about 20,000 before it ended in the 90s. And then we were able to not continue to add staff and start to decrease the staff. So the first thing we did is bulk up the staff a lot. Another thing we had to do, if you're going from 3,000 people to 20,000 people, you've got a lot of people you have to train, and in all manner of things, how to examine banks and how to handle bank failures and the like. And so we had training facilities in just outside of Washington, D.C., and I think it was Arlington or Alexandria. I don't remember exactly where it was, but we had a small training center that was in rental property. And so one of the next things I did was to authorize the building of a new training center, and we bought land near George Mason University, and we built a training center, a state-of-the-art training center, and where we trained not only people from the FDIC, but a lot of state agencies sent people there, state banking agencies, as well as the Federal Reserve and the Controller of the Currency sent people there to be trained. So that was another major undertaking we did. We had to change we changed a lot of the compensation and employment programs. That people were having to travel all the time, and so we had to take that into account when we paid them. And people were going to all different parts of the country with different pay scales in different places. And so we had to accommodate that. So there were a lot of things we had to do to get the FDIC ready to face what it was facing. It all went amazingly smoothly for what we were doing. And I was very pleased with it. And I think the staff responded great. I mean, they really were terrific, and they put up with a lot of nonsense or what they might have thought was nonsense, but we knew had to be done. And we couldn't afford scandals, so we had to make sure we were paying people properly for their expenses and all this stuff. We really did a lot of things to bring the agency up to speed. And that's probably one of the proudest things I am about my time at the FDIC, is how we took it from an agency that really wasn't ready for what it was facing, and we got it ready, and it performed really well. I'm very happy with the FDIC and the quality of the things they did. In fact, the Congress sort of adopted what the FDIC did, and because we were not subject to the federal pay scales and all that sort of thing, and the other agencies were. And so Congress gave to the Controller of the Currency and the Fed a lot of the FDIC's programs and made them lawful for those agencies as well. So we brought I think all the agencies up to speed in a meaningful way.
Well, that's great. So with going from 3,000 people to 20,000 people, the infrastructure that you talked about is important. How did you build the culture where people were really focused on the right risks and actively engaged in kind of managing those risks?
Well, that was a process, and that's what the training center was for. And I mean, one thing that I tell you that I was very sensitive about, we were handling billions and billions of dollars in these failed banks, because they were many, many billions of dollars of assets that were being turned over to the FDIC to manage. And one of the things that I addressed early on was we've got to have the right controls in place, because you can't turn over billions and billions of dollars to people and say, handle these, and not have them handled right, because that's the potential for enormous scandal if you don't handle them right. And that's one of the things that I emphasize very strongly practically every day. We will not have scandals. Do everything precisely right. Have the right controls in place, the right approval process, and so forth, and use the right experts for the opinions of value and all that sort of thing. that was one of the things that scared me the most, because you have an agency that hadn't done a lot for the last 50 years in terms of managing assets, and now it had to manage tens of billions of assets. And it was, I'm proud of the fact that to this day, I don't think the FDIC has had a scandal about asset values and what it did, which is really wonderful to be able to go. I say I've been out of office about 40 years, so I think those controls have stood the test of time. And we had lots of audit procedures and things we put into place, and yet we didn't want to handicap the people who were doing the work. We couldn't put enormous burdens in their way, so they couldn't act efficiently. So it was a really challenging situation to say, do the right things, but don't take too much time doing them. So,
well, sure. And I think that you bring up a great point for a lot of growth companies in whatever industry, is if you're going to grow and you're going to grow fast, you need to have all the right policies, the procedures, the controls, and the audit functions to ensure that you're not going to have the blind spots of the variance of people doing things differently and creating the scandals that you were talking about.
Mm-hmm. And when you go from 3,000 people, most of whom weren't handling troubled assets, they were just doing bank examinations. So you go from 3,000 people to 20,000 people. A bunch of them you don't know. I mean, you just hire them. You're training them to do the right things. That's really scary. I mean, it is. It makes you really nervous as a CEO of a place. How do I get this growth and not have it be out of control? Not to have people that we don't know, we haven't maybe trained them properly, and so forth. So that was a real challenge, and it's a challenge that every bank faces. It's not, the FDIC was becoming a very big bank in a very big hurry, and most of the assets were very troubled. And so imagine if you're running a bank, what that's like. And so that's the challenge that a lot of banks face day in and day out. Hopefully not to that extreme, going from 3,000 people to 20,000 people in a matter of a couple of years. So hopefully not that fast a growth, and hopefully not all troubled assets. But that's sort of a wild and crazy version of what banks go through. But banks do go through those problems, and that's where they get in trouble frequently. And that's what I was very sensitive to, because I'd been in the banking business, and I saw troubled banks back in the 1972 to 74 period. I was with one of the largest banks the largest bank in Wisconsin, and they got into that REIT crisis that we had back in that period. So I saw what went on when you had rapid growth in troubled assets, and how hard it was to deal with it. And so that was a lesson that I had coming into the FDIC. And the bank that I was with in Kentucky was not as big and as troubled as others. It was relatively healthy, but it had its problems. And I was general counsel, so I had to deal with a lot of those problems. And so that was really good training for what I was about to embark on at the FDIC, because I got what I inherited was a great big bank that went from 3,000 people to 20,000 people, and all of the loans were troubled. Almost all were troubled. And so how do you deal with that and not have a crisis on your hands in terms of failure to do the things that need to be done to control losses and fraud and all that sort of stuff? And that's sort of a big problem that you're faced with, but it's the same problem that most banks are faced with, maybe smaller scale. For most banks, there are some banks that are much bigger than that, and they have much bigger problems they have to deal with. So that was a real lesson I had that was helpful.
Well, that's great. So then after the FDIC, you went through a period where you were practicing law and you were doing some consulting. And so how did you end up at Fifth Third Bank?
Well, I left the FDIC and I decided, it was funny, I was trying to decide, what do I want to do? And I thought, well, the logical thing, since I just ran this FDIC through a crisis, would be to join a big bank. And And then I thought about it and I thought, I don't think there's any bank that's going to satisfy me after what I've been through. What I just described to you, thousands of bank failures, no weekends off and everything. I just don't think I'm ready to go be as calm and peaceful as it would be to go to a normal bank after this. And so I decided that what I really would be good at was helping banks get through troubles and to try to help them learn how to handle assets properly and make loans properly and all the things that it takes. Because the period that I was at the FDIC, it was transformational, big time transformational, because during the 1930s, Congress decided that banks should not be taking a lot of risks. We didn't want to go through another depression. So what we wanted was a financial system that was absolutely safe and foolproof. And so that's what they gave us. And they were successful at it. Banks had all sorts of controls on them, where they could branch, whether they could branch, where they could operate their banks, what they could pay for deposits, what they could charge for loans, what kinds of loans they could make, what kinds of non-bank activities, financial activities could they engage in. And so banks and thrifts all had their little sandbox and they had their rules. And the rules were designed so that they didn't create huge problems for themselves. They wanted the banks and the thrifts to be safe. And then non-banks were told to stay out of the banking arena. You don't belong there because this is our safe place. And so if you're an investment bank where you're going to take all these wild risks, that's okay, but do it in your own sandbox. In banks, you can't go over into that sandbox. So those were the rules we had, and they worked. From 1934, when the FDIC was up and running, to 1980, we had very few bank failures. We started to get some in the late 70s, but prior to that, we had almost no bank failures. And the reason we didn't was because we had all these controls on what banks could do and what they couldn't do, and who could be in banking and who couldn't be. But all of that fell apart because Congress lost control of fiscal policy. They started spending money like drunken sailors. I don't mean to demean drunken sailors, but the Congress was spending money worse than drunken sailors. We had massive deficits. We had the war in Vietnam, which was very expensive and terrible in most other ways as well. I was in college in the 60s, and I was one of those people who was very unhappy with the war in Vietnam. And then we have the Great Society programs that Lyndon Johnson did, and those were not paid for, just as the war was not paid for. We had massive deficits building. And then the Fed accommodated all that with loose monetary policies. So that caused inflation throughout the late 60s into the 70s, and it was really out of hand. And Jimmy Carter, to his great credit, Jimmy Carter appointed me to the FDIC board, and as a Republican to the FDIC board, and he appointed Paul Volcker to the Fed. And I went on the FDIC board in 78, and Volcker went on the Fed board in 79. And his instructions were kill inflation, get it under control, get rid of it. And so that's what we did, and Volcker took the interest rates up a lot, the prime rate ultimately went to 21.5%. Imagine that. You're running a small business. You're used to 7 or 8% interest rates, or you have a home. You took a mortgage out, or you want to take a mortgage out, and you're used to low rates, and all of a sudden you're paying 21.5%, the prime rate, and money's hard to come by. In addition to that, in addition to being expensive, it's hard to find. So it created massive economic problems. But what it really did to the banks and thrifts was it changed their whole business model. You can't have interest rate controls on what you pay depositors and what you charge lenders borrowers. You can't have those kinds of interest rate controls in place when the market rates are up at 21.5%. So that meant that all those controls we put in place in the 1930s had to be taken off quickly, because if banks were not allowed to pay up for their deposits, they're not going to have any deposits. And that's not something we want the banking system to have, is zero deposits. And that's exactly what would have happened had we not liberalized and said, okay, we're taking off the interest rate controls on what you can charge for loans and what you can pay for deposits. And we're taking off as many of the other controls as we can. We can't have you all tied up. So let's take Illinois. Illinois had no branch banking whatsoever around the state, and no interstate banking. And we had continental Illinois sitting there about to fail. And it was the seventh largest bank in the country. And who was going to buy it if we had to handle the failure? Nobody, because nobody could branch anywhere in the country, right, and much less in Illinois. And so there was a lot of structure in place from the 30s, which I appreciated, I liked, because it made our job a lot easier. But it wouldn't work in this new era. And so we had to get rid of all that structure that went in the 30s and put in a new structure, basically less rules, fewer rules, and more hands-on enforcement. We didn't have rules telling you couldn't do dumb things. So we had to go in and make sure you weren't doing dumb things. And so
we inspected quality into the process.
Yeah. And so we really had to restructure the whole system, and we had to do it quickly on the run while we were handling failures. And that's what it was like. And that's why you never had any free moments at all. You never had any time to breathe and think even. You just had to keep on going and do stuff. And that's what the 80s were like. Far different than what came after, because you're restructuring a banking system while you're handling 3,000 failures. So there's never been a period quite that hectic since, despite what people say. That was a really tough period. And
so after the FDIC, you had to take a breath, and you had to find a hobby. Talk us through your post FDIC time.
Sure. Well, obviously I needed a breather, but I didn't take one. I actually didn't have a day between the FDIC and my next job. I moved immediately from the FDIC to my next job, which was I joined a major law firm, and I established a consulting firm for banks and thrifts and other financial institutions that was a part of the law firm. The law firm owned part of it. I owned the rest, and then I brought people in and they owned some of it. But I created that on the run without any vacation at all, because I felt it was important to keep on going. And I was a young man, so I could do that. What I decided was that rather than go to a bank, because I thought it would probably be pretty boring after that experience at the FDIC, and I didn't think I don't think that really appealed to me in terms of using my skills to their best use. I thought that what banks needed, since we were coming into a way different environment, we're deregulated, we got to teach banks how to deal with this environment. And so I set up a firm called the Secura Group, and the purpose of it was to help banks figure out how to run themselves in a deregulated environment where they had to decide what to pay for deposits and what to charge for loans, and how to manage risk, and how to deal with the new regulatory regime and so forth, and how to branch all over the country without getting in trouble and so forth. So that's what I decided to do, and it was very successful and very satisfying. I hired a bunch of people from the regulatory agencies, high level people, and some senior people from banks, and put together this firm. And it also had a talent part of the firm, executive search, because banks clearly going to have to hire a lot of new people that knew different things than they
Sure.
used to know. And so that's what we did, and it was very successful. And then a lot of, not a lot, but some, as you can imagine, competitors came up because they saw what we were doing, and they decided that was a good way to make a living too. So we had competitors come up, and for the first 10 years or so, we had basically a monopoly because nobody else had what we had, and then others started to add firms, people to their firms like ours, and so it became less interesting in terms of there were a number of other people doing what we were doing, and it was not as fun as it used to be, and not as necessary as it used to be. Around that time, we were working on two large regional banks. One of them was Fifth Third. I won't name the other one, but it was another bank of that size. And we were trying to help them because we were in the 2008 and 9 period where the system all broke apart again. I thought we had finished all these bad times with what Boker and I did in the 80s, but apparently we didn't learn all the lessons so adequately. And so we had a breakdown in the system around 2008, 2009. It was primarily a real estate problem, and it was widespread, but it became far worse. I thought it was terribly mishandled. Congress adopted the TARP program, not well done, but it did cause a lot of problems. People were panicked, and that's why I wrote a book in that period called Senseless Panic: How Washington Failed America, and that was my response to the TARP program and how they mishandled the situation. But during that period, a lot of banks that otherwise, Fifth Third had been extremely profitable forever. I think they had, I don't know, it must have been at least 30 years of record earnings, but they got in trouble during that period of 2008, 2009, as a lot of people did, and our firm was consulting with them, trying to help them with their problems, and one of their lead director came to me and said, "How would you like to leave what you're doing and become chairman of the board of Fifth Third?" And I thought about it, and I thought, sure, why not? What I'm doing is not as unique anymore, and I'm ready to do something else. And so I agreed to do it. And I had 5 years until I would meet their mandatory retirement agency. So I agreed to be the lead director for 5 years, and I was, and I enjoyed it immensely. I think we made a lot of improvements at Fifth Third. And what they did is they separated the chairmanship from the CEO's role because they felt that they needed an independent chairman, which a lot of banks did during that period. And so Fifth Third named me as the independent chairman. And I found it very satisfying to take all those things that I've learned and put them to use back then. And Fifth Third came out of it very nicely. And they were a great bank before then. They got in some trouble. They needed some help, and they became a great bank again. So I was very pleased with that. And then I joined another consulting firm for a while, and I didn't like working for a consulting firm that wasn't mine.
So when you were at Fifth Third, and this is more than 10 years ago, and a lot of banks were focused on a lot of different kinds of risks coming out of the Great Recession, what was Fifth Third's biggest risk that had to be managed through at that point?
Loan quality, and that was unique. They hadn't had loan problems previously, but they were growing more rapidly, and they were growing more rapidly over a broader geographic area. They were in Cincinnati and other parts of Ohio. They went into other states, including much of the South and Ohio. Well, Ohio they were in, Indiana, West Virginia, Michigan, another one, Florida. And so they were growing and growing more rapidly than they would otherwise have grown because they were over a smaller geographic area earlier. And they didn't have probably the right controls and people in place to do that, all that fast. And that's how people generally get in trouble, as they're taking on more than they can chew.
Well, very good. So at the same time, coming out of the Great Recession, the CFPB was created. And so from a board perspective, in your role as the independent executive chairman, kind of what was the view of the CFPB controls from a culture perspective, from an infrastructure, the investment perspective, as it was being built out, and the compliance part of it was being built out at Fifth Third?
Well, I didn't fight the CFPB coming into existence. I thought it was a bad idea, but I thought, how bad can it be? I mean, we're already doing compliance in all the banking agencies, and how can the CFPB be a lot worse for banks to deal with? And so I stayed quiet. I didn't object to it. I'm not sure I could have done anything to change it if I had hollered, but in any event, I didn't. I just thought, well, this is a bad idea, but it can't be that bad. And so I kept quiet. Turns out that it's been horrible. And the reason it's been horrible is because they didn't create a CFPB properly. It should have a board of directors, a bipartisan board of directors, and it doesn't. It has a single agency head who has almost no rules. And the agency itself has almost, the charter for it is also ill-described, if described at all. So they sort of make up their rules as they go along. And when I say they, it's really a single agency head who makes up whatever rules are deemed appropriate. And I don't think that ever works. I mean, what they do is they start taking on more and more and more responsibilities. They like to change the world, and so they do whatever needs to be done in their minds to change the world and make it perfect. And so I don't think it has worked, and I don't think it ever will work unless Congress comes in and treats it like most every other federal agency. And that is, gives it a structure and a governance structure and a leadership structure to make it do the right things in the right way, to make it accountable to somebody. If I were the Congress, I would give them federal funding. They have to go to the Congress and ask for money. I would give them a board of directors, an independent board of directors, appointed by the president, bipartisan, and probably 3 members and fixed terms, say 6 years or whatever. And I'd give them some guidance. I give them some rules about what it is they're doing. What's their enforcement power? What are they trying to do? What rules do they have to follow? None of that has happened. And so to me, the CFPB is a mess. And it shouldn't be. We should have proper rules in consumer compliance. I think we did have the proper rules. I know the FDIC devoted a lot of money and people to enforcing consumer compliance. That was an important part of the FDIC's job. I know the Fed had that as part of its job. The OCC had that as part of its job. The state banking agencies have that as part of their job. We didn't need a separate CFPB, but if you're going to have it, then set it up right and give it some rules and some guidance and make it spend money that it collects either from Congress or imposes on banks, whatever it's going to do. I can tell you that when the agencies were doing consumer compliance, it was a tough job to comply, but you knew the rules. The agencies would make it clear what they expected of you and what they would do to you if you didn't do the rule right. And we don't have that anymore. So I didn't even know what to advise a bank on how to comply with consumer compliance, because I don't know what the CFPB is going to come out with next. It's really hard. So I think I have a lot of sympathy for where banks are on that issue, and we need to change it, and the Congress needs to change it. It's not the American system. It's not. That's not how we govern. We govern in a bipartisan way. We appoint good people. We tell them what the mission is. We tell the banks what we expect of them, and then we enforce it with career people. And we're not doing that now, and it's terrible. It's a terrible outcome.
So, based on that, what we saw during the Great Recession, what you saw during the '80s, let's pivot to kind of the bank failures that we're seeing over the past 6 months. What's different, and do we need what are we thinking about in terms of managing the current situation?
Well, we haven't managed the last 6 months very well. That's roughly the time period we're talking about. And to me, it's I don't know. I'm sort of depressed about it because it's deja vu all over again, as Yogi Berra would say. Everything that was happening back in that last 6 months was a relic of years gone by when I was chairman of the FDIC. We saw all those problems back then, and we took care of them. And we hoped that the lessons would be learned forever, that people wouldn't repeat those problems because they learned something from the period of the 80s. But let's take Silicon Valley Bank. Silicon Valley Bank had a problem with an interest rate mismatch. They bought a bunch of fixed rate government bonds, as I understand it, and at a time when rates really couldn't do much but go up, because the Fed had rates down at an incredibly low. I mean, the Fed policy was terrible. They had rates down to somewhere close to zero, 1%, 2%, whatever, and that monetary policy was very bad, and fiscal policy was also very bad, and so we had a rising rate environment for sure. And why would you go out and buy a bunch of fixed rate government bonds and load up? And they tripled in size over a 3-year period.
They didn't follow your FDIC playbook, did they?
No, I mean, the first Pennsylvania did that in 1979. That's a failure I handled in 1979 with Paul Volcker. First Pennsylvania, I guess, missed the message that Volcker was being appointed Fed chairman to raise rates. They didn't read their paper that day, I guess. And they went out and loaded up on fixed rate government bonds. First Pennsylvania was the oldest national bank in the country. #1 charter, because it was started back in the Civil War. I mean, they became a national bank in the Civil War. So they were the first charter when the national charters were allowed. And they've been around all that time. And they didn't think that loading up, expanding their balance sheet and loading up with a bunch of fixed rate government bonds could be a bad idea when you have rampant inflation and a new Fed chairman directed to raise rates. And
so then we flash forward to SVB, who did the same
thing. They did the same thing. And so you have to wonder, what were these people thinking about? Were they thinking? And I mean, that's the 1980s all over again. But you already saw it once. Why do you need to go watch the movie again? So, do
we think that enough other banks either have or are currently working through the same examples that SVB gave us as to how to not risk manage?
I believe that there are other banks that have a lot of fixed rate long-term loans or bonds or whatever it is they have. That was not unique to Silicon Valley Bank. It was the worst. Just as I don't think what First Pennsylvania went through was unique, but it was the first and the worst. And then others will follow on behind. How many failures are going to occur? I don't know. I said that at the time. Everybody said, it's just, does First does Silicon Valley Bank, does that mean we're going to have massive bank failures? I don't think so. For one thing, we don't have massive banks anymore. I mean, back then in the First Pennsylvania days, we had 13,000 banks and 5,000 or 6,000 thrifts. So we had a lot of banks and thrifts with fixed rate loan problems. But so we don't have that problem in that kind of scale today. But it's not the only bank that that has mismatch on their rates. And so I think that others are going to suffer from it. Will they fail? I don't know. Some might just have some lousy earnings for a while until they get out of the mess. And the rates won't be up forever. They're going to come down at some point. And if the banks aren't too bad off, they'll make it. They'll get through it. And I don't see anything nearly as bad as Silicon Valley Bank out there, with the possible exception of First Republic, which came down as well for much the same reason.
Sure.
Both of those banks added tons of growth in the last 2 or 3 years of their lives, which was just uncalled for. It was I don't know what they were thinking.
Well, so what are you seeing as the trends from a risk management perspective, and trends from a weaknesses that people should be focused on from regulatory or risk pillars within the banking organizations? What are you seeing besides the risk mismanagement on the asset and liabilities?
Well, that's a big one, very big. And when you have when you have mismatches like that, you're likely going to have asset quality problems, period. You might have loan quality problems and things, because the borrowers may not be ready for what's happening in terms of increasing their rates. So that could lead to credit problems. In the case of Silicon Valley Bank, that was just a mismatch on their bonds. But that also could have led to asset quality problems. They're loaning money to borrowers that can't handle the increase in rates. And so it leads to credit problems. And then if you're being sloppy in those areas, or careless, or whatever you want to call it, you probably are taking more risks in other areas that you're growing too fast in other areas, or whatever it is you're doing. You're expanding too fast. So there's never, when let's take Continental Illinois. When Continental Illinois got into trouble, it was the 7th largest bank in the country, so it's pretty good size and had some diversity. But you saw them get into trouble earlier. I mean, we saw it when they started making bad loans.
Mm-hmm.
When Penn Square failed in Oklahoma in 1982, who was one of the biggest lenders to Penn Square? Continental Illinois. And I said in 1982, we better keep an eye on Continental Illinois, because they had way too much money in Penn Square, and therefore they probably have way too much money elsewhere. And sure enough, that was a telltale sign that came true, because
So they had concentration risk. So if we think about that and the things we've been talking about so far, what do you think the regulators are going to be looking at from a vulnerabilities perspective during their exams over the next 18 months?
Well, always they should be looking at concentrations. If you're not properly diversified, then you're not properly protected against losses, significant losses. So diversification is really important, and it's not just. It's diversification everywhere. You can't have too much of anything and get away with it forever. And I was with First Kentucky before I went to the FDIC, and First Kentucky was a regional bank, the largest in Kentucky, and relatively small bank in today's world, but that was a different time. Everybody was smaller then, but anyway, the CEO of the bank, or the chairman of the bank, he wasn't the CEO, he'd been the CEO before. He was very proud of the bank's record. And he said, he used to brag all the time about, our bank has always been successful. We have not had a down year in earnings. This was I went to First Kentucky in 1975. Okay.
Mhm.
He said, we haven't had a down year since 1930 something. It's 40 years. They hadn't had a single down year in earnings. And he said, the reason why we haven't had a single down year since 1940 or 30s is not because we're smarter than anybody else, because we're not. It's not because we're luckier than anyone else, because we're not. He said, it's because we diversify. We do dumb things. Don't get me wrong. We do dumb things. We've made every mistake every other bank has ever made, whether it was LDC loans or whether it was, housing loans or whatever. We've made every mistake that every other bank has made, but we've never overdone it. We've always had a diversified, balanced portfolio. And that's why we've had record earnings for 40 years. And that's the primary lesson I would tell any banker or any bank regulator. That's the key to success. Don't overdo it. Don't think you're smarter than everybody else, because you're not. You're smart, you're good. And if you really are smart and you're really good, you'll diversify your risk all across the board. Don't do anything in excess.
So, as a board member of a bank and being involved in so many banks, what would your kind of executive board member advice be to the chief credit officer, to lending officers about their portfolios currently and as they make new loans?
I think I just gave you that advice. I mean, that's what I would tell. That's what I would tell Fifth Third. That's what I would tell anybody. I mean, don't think you're the smartest person in the world. You're not. You have all the frailties everybody else has. You're not a super genius. You're ordinary smart people. And smart people don't take big risks, and they sure don't take them in excess. You're not the smartest guy on the street, and there are other people that are smarter than you are. And don't think you can't make mistakes. You do make mistakes, and you will make mistakes. Just don't let the mistakes kill you. But I would also say, don't be afraid to make a mistake, because then it paralyzes you. You have to take risks. You're in a risk business. I mean, what good would a bank be if it didn't take any risk? And so take risks, but don't overdo it. Put a cap on it in every way, whether it's interest rates, whether it's credit quality, whether it's geography. Don't put all of your loans in the same geography. And that's why, the FDIC was created in the 30s. And before that, we had practically every state in the union had an FDIC type insurance company. Okay. And they all failed. Every one of the state chartered insurance companies failed multiple times, because whenever they had a recession or depression, they had all their risk concentrated in that state, and they wound up failing. And so Congress said, we can't do this again. Let's create a federal deposit insurance corporation that spreads its risk all over the country. And that's the whole basis for the FDIC, is not to have excessive concentration geographically or by industry or whatever. And so that's why the FDIC, when they come to your bank, if they're doing their job right, they should be looking at your concentrations, geographic concentrations. And so let's say you're a bank that's in one state or one part of a state. That makes you more dangerous than a bank that has a lot more diversification. I not necessarily, but if you don't protect against that concentration, you're going to be in trouble. And so the FDIC, when they come to examine, they ought to be looking at where are they banking? What are the businesses in the areas where they're banking? What are the vulnerabilities of the businesses in those areas? Do they have too much of it in this bank? I mean, let's say you're a farm bank. If almost all of your credits are in the local farming area, well, you know that's higher risk than if you were spread over a broader area, and you didn't have your primary risk being agriculture, because that's a unique risk that they get in trouble pretty much all at one time. And so if you're structured like that, you've got to say, well, I'm going to have to be more careful with my loans. I'm going to have higher lower loan to value ratios. I need to make sure I've got perhaps some extra credit, some kind of guarantees or something if I'm going to take a lot of risk. So that's what I'm saying is no bank is like any other bank. They're all different, and they all have to evaluate their risk and diversify those risks. And some banks don't have to worry about it so much because they are so broadly diversified. There are other banks, they have to worry about it a lot. If I owned an agricultural bank, I would be in it, and if 60 or 70 or 80% of my loans were to agricultural, to farms, I would be careful, very careful about how I lent. And you're doing that for the sake of the community. What good are you to your community if you fail? You owe it to your community to be diversified. What good do you do a borrower to give them too much money and fail? And
exactly. So, it seems like when you're talking about credit, the FDIC currently is looking forward and seeing a bit of a credit crisis coming, or credit weakness, I should better say, because they updated their interagency guidance on commercial real estate and loan workout. This is the first time they've done that since 2009. So that's clearly signaling what we shouldn't be surprised about is on commercial real estate is the vacancy rates and rising interest rates kind of for those fixed assets. So I think the FDIC is coming out and signaling that they're expecting the weaknesses to come.
And it's late. It's late in the day for that warning to come.
Yeah,
because most people have seen the real estate problems develop long ago, years ago, and in fact, it's hard to even know where it's going because clearly a lot of people are leaving the cities. And so what's that mean to the value of real estate in those cities? So if you aren't being very careful, you should be, and you should have started that several years ago. And so if you're just now getting the idea that maybe it's risky, I mean, you look at what's going on in the cities with the riots and the homelessness and everything else. Is it time to be concerned about the value of real estate in those cities? Of course it is. It doesn't take a genius to figure that out. Does that mean that all the real estate in the cities is going to go to pot? No. It just means you better be careful. It should not be business as usual that
right.
You build building after building after building and not worried about it. And so that's what happens in banking too often. People start going a certain direction and they don't stop and say, wait a minute, have we gone too far? Should we pull back a little bit? Some people do pull back, and that's why they survive. Some people don't, and that's why they don't survive. And so it's time to be looking at. It's always time to be looking at those things. And if you need a regulator to tell you it's time, you probably need new.
It's too late. It's too late.
It's too late. Yeah, it's too late.
So let's switch for just a moment, Bill, if we could, to talk more about from a perspective of a business leader and kind of or hold on. We'll cut that. Let's shift for a moment and talk about from the perspective of business leaders and operating companies. And I want to discuss kind of one of the things that you and I have talked about before is the focus on working with banks of all sizes, because after SVB, people had a knee-jerk reaction that was, let's move all to a larger bank. And that's not necessarily the best way to handle that. And I'd like for you to talk about that.
Well, I firmly believe that we need in this country banks of all sizes. Clearly, we need some big banks, and because they can make loans that need to be made that small banks can't make. They're across the seas or wherever they are. The big banks have a market that only they can fill, and small banks can't, or even medium-sized banks can't. But just like the big banks are doing things that the small banks can't, the small banks are doing things that big banks can't do very well. I mean, they're used to mass marketing. They're not used to. I'm from Bryan, Ohio, a town of 8,000 people in Northwest Ohio, and there are big banks that have, by big banks I mean some regionals that might have an office in Bryan, Ohio, but they don't know Bryan, Ohio. They never will know Bryan, Ohio, the way the small banks do. Mm-hmm. And they can't fulfill the needs the way small banks can, because the small bank, they know the people, they know the businesses, they know what works, what doesn't work. And we really need those kinds of people in banks that are serving small to medium-sized communities. And they need to have a presence there. I mean, if they don't have a presence there, who's going to sponsor the Little League and other things like that the small banks do? They're part of the community. They make the community work. And I know that because I grew up with that. And so I also see the fact that the regional banks are unique. Let's take Fifth Third. It serves a larger group of businesses in its communities, and it's serving larger communities. It's in places like Cincinnati and Columbus and Cleveland and Grand Rapids and Indianapolis and so forth. Larger communities with larger products and broader products and so forth. So there's a place for these banks, and I think that if the U.S. got to the Canadian system, which we're headed in that direction, I hope we stop. You only have 3 or 4 banks in Canada, and the rest of the things that are going on are credit unions. You have credit unions that are serving a bunch of people in Canada, but almost no banks other than the big, whatever it is, 3, 4, 5. And I don't want to see that system in the U.S. I don't think that's what our country's all about. I think we are a very diversified country, geographically, culturally. We live in big towns and small towns and middle-sized towns, and we have strong opinions in different regions of the country on different things. I really do believe that. And I grew up in a small town, and I didn't stay there, although I really didn't move to big cities. I started in Milwaukee, and I went to Louisville, Kentucky, and then I went to Washington D.C. at the FDIC, and then I moved to Florida, where I am now. But I believe in our communities in this country, and I believe in them more than I believe in banks per se. Banks our banks are there to serve our communities, and so I think we ought to allow to develop, but we actually did allow to develop, and we need to keep them. Banks of all sizes that fit and work in communities of all sizes with different needs, and I think it would be a very sad day for our country if we didn't do that. If we let this country continue to minimize the banking system and reduce it to a handful of bigger banks. A terrible mistake. And that's the way Europe is. It's the way Canada is. And I don't think it's right for America. I really don't.
So when we think about a lot of the online lenders and that are targeting the commercial side, what that does is it really commoditizes a loan as opposed to building that relationship. Do you have any advice for both lenders and borrowers on how to optimize that interpersonal banking relationship and moving back away from some of the commoditized loans?
Well, the people who are looking for commoditized loans are looking for a low price, a relatively low price. If they weren't getting that, I don't know why they would go to an impersonal mass lender. And so they're looking for a low price on perhaps a commoditized product where they don't see a difference.
Mhm.
But if you're looking for something that's more personalized, that's more geared to the customer, you don't buy the commoditized price, because you're not going to get what you want, which is personal service, personal knowledge of you and who you are, your family, what you need, how the bank can be helpful to you and your community. If you care about those things, you're not going to buy a commodity. If you want a commodity, you don't shop at the local grocery store. You buy from Amazon. Okay, and I prefer not to buy my groceries from Amazon. I'd like to go to the grocery store and look at them and see what they are and pick them out and choose what I want to choose. And if I pay a little more, so what? I'm getting something for it. And I think that's what we're talking about is, do you want to buy everything from Amazon, including financial services, or do you want to be able to do business with local businesses that know you and can cater to you?
Well, I think the catering and also understanding the local market and delivering on being the banker, being an advisor, how do we help you with your financial structure, adds value in that process, and not just trying to sell to the low price, because I think that is, for a brick and mortar especially, kind of a failed business model. So that you need to have some of that advice and kind of that relationship.
Yeah, a couple of weeks ago, we wanted some food, and we didn't feel like fixing it, and we didn't feel like going out to the restaurant. Okay, so what's the choice? You call Uber or whatever, Uber Eats or something, and you order some food in the house. Okay, guy delivers the food half hour later, whatever it was, walks in our front door. Didn't knock, didn't ring the doorbell, just walks in our front door and says, "I'm here." That taught me a lesson. I said, "What are you doing in our house?" I'm just saying, you give up something when you go for that convenience of somebody bringing the food to you. You don't know who's going to walk into your house, or if they're going to walk into your house, or what they're going to do while they're there. Okay. And that sort of says it all to me. It sure taught me that I'm not going to be quite so quick to order out.
Well, very good. So, Bill, in your public sector and your private sector experience, I'd love to have some insight as to one of the kind of most unconventional approaches to managing risk that you found surprisingly effective or valuable.
Who was it that says the best surprise is no surprise? Somebody had that advertising logo, I think, and that's true. I mean, that's my philosophy. If you plan for zero surprises, or close to zero, at least major crises. I mean, you're always going to have small surprises. There's always going to be somebody who does something wrong and you fire them. Okay, and that's another thing. If somebody does something wrong, they're either not trained right, in which case you got to change your training, or they're not reliable. They don't have the right mentality, the right standards, and so you fire them. You need to get rid of people that aren't doing the job right. If you keep somebody around that you know is not doing the job right, shame on you. Either
I
train them
certainly
better, or get somebody else who has higher standards. And
well, speaking of,
I don't think you should have surprises, if big surprises, if you're in financial services. You shouldn't have them. If you do, you've done something wrong. You got to change it.
Bill, thank you very much for your insights and experience talking today. I think it's been really valuable. I think there are a number of key takeaways that people have, both on the bank failures of the past as well as the current, about the regulatory environment and working with your banks and not just fleeing to the larger banks, but actually staying with the community banks and regional banks because of their value add. And I really want to thank you for your time today to be able to share that with our audience.
Thank you for having me. I truly enjoy it. It's fun to talk like this and spread the word to all the banks. I mean, I do think that I love our banking system. It's the best in the world, and I want it to stay strong and even get better.